Dell Technologies just dropped a blockbuster earnings report that honestly feels like it's telling two completely different stories at the same time. On one hand, you have this incredible, record-shattering performance, all thanks to the AI boom. But on the other, there's a big shadow looming over its profitability. Okay, let's dive in and really unpack what's going on here.
From Dell's point of view, things could not look better. Their vice chairman, Jeff Clarke, kicked off the earnings call with this statement, and for good reason. He's highlighting a record-breaking quarter that just blew past everyone's expectations. Revenue wasn't just up, it was up a massive 19% from the year before.
But even as the champagne corks were probably popping over at Dell, investors and analysts were already digging deeper. And behind that incredible headline number, they found something that gave them pause. And it all led to one central nagging question.
And this right here is the heart of the whole debate. Can Dell turn this massive wave of AI-fueled sales into sustainable long-term profit, or is it just chasing enormous revenue with margins that are getting thinner and thinner? Let's break it down.
First things first, let's just appreciate the numbers behind this huge quarter. The top-line results are seriously impressive, and they paint a picture of a company that is absolutely firing on all cylinders.
The big one, nearly $30 billion in revenue. And that's not just a good number for a single quarter. That is an all-time record for the company. Just wow. And they didn't just squeak by a previous record either. A 19% year-over-year growth rate for a company the size of Dell is a staggering achievement. It signals absolutely huge demand for what they're selling. So looking at this summary table from their report, you can see growth pretty much across the board. Revenue, operating income, earnings per share, they're all up and up significantly. On the surface, it looks like a completely flawless report card.
So what's the secret sauce here? What's fueling this incredible engine? Well, no surprise to anyone following tech, it is all about artificial intelligence. Dell has put itself right in the middle of it all as a key supplier for the hardware that powers this AI revolution. And this chart, wow, this chart tells the story perfectly. Just look at that trajectory for their AI-optimized servers. It went from basically zero, not that long ago, to now being on track for $10 billion this year, with projections to double that again next year. That's not a line. That's a rocket ship.
And the momentum is just incredible. They shipped a record $8.2 billion in AI servers just this quarter. But, and this is maybe even more important, they have a backlog of almost $12 billion. That's a huge line of customers waiting for orders. And that massive unfilled demand is exactly why they felt confident enough to raise their full-year forecast to $20 billion.
This isn't just about volume either. Dell is at the absolute cutting edge. This quote from Jeff Clarke is a big deal. It highlights that they were the very first company in the world to ship NVIDIA's latest and greatest AI chip, the GB300. This proves they're a go-to partner for the most advanced stuff out there.
Okay, so everything sounds amazing, right? Record sales, cutting-edge tech. Well, here's where the story takes a sharp turn. This is where the market's excitement slams head-on into a major concern, creating what we're calling the margin mystery. And the crucial point is right here on this slide. While that revenue number soared 19%, their non-GAAP gross margin actually fell, and it fell hard. It dropped from over 21% last year to just 18.7%. So what does that mean in plain English? It means that even though they're selling more than ever, they're actually making less profit on every single dollar of sales.
And you better believe Wall Street noticed immediately. This note from the analysts at Morningstar just perfectly captures the feeling out there. Yeah, the AI sales were fantastic, but the hit to their profit margins was way worse than anyone was prepared for.
So, as you can imagine, this whole conflict has basically split the investment community into two very different camps on Dell's future. You've got the bulls, who see a massive opportunity, and you've got the bears, who see some serious risk.
The bulls, well, they argue these are just growing pains. They're saying the AI wave is only just beginning, and as Dell gets bigger, they'll be able to attach higher margin services, networking, and storage to all these big deals. But the bears, they're worried that selling AI servers is just a low-margin commoditized business, and that this trend is going to permanently hurt Dell's bottom line.
Now, to really get why the bears are so worried, we need to quickly touch on a key financial idea called the economic moat. Just think of it like a castle's defenses, right? It's what allows a company to fend off competitors and protect its profits over the long term.
And here's the problem. According to analysts at Morningstar, they give Dell an economic moat rating of none, 0. And why? Because at its core, Dell sells hardware in a market where it is incredibly difficult to stand out. Your competitors can offer very similar products, and that leads to intense price competition that just squeezes your profits.
Okay, so Dell is facing this classic dilemma. Absolutely massive growth, but shrinking margins. So how are they going to navigate this? What does the future actually hold?
Well, here's Dell's three-part game plan to fix this, and it comes straight from their earnings call. First, they're going to aim for a better sales mix, balance out that low-margin AI hardware with more profitable stuff. Second, they think they can find cost savings as they get bigger and scale up production. And third, and this is the most important part, they're going to try to attach really lucrative services and networking deals to their big enterprise AI sales.
And look, this isn't just talk. Dell is putting its money where its mouth is. This slide shows that they actually raised their forecast for the entire year. That's a huge signal of confidence that they think they can manage this margin pressure and still deliver strong profit growth.
And it seems that even some of the skeptical analysts are starting to come around, at least a little bit. After the report, Morningstar actually raised its fair value estimate on Dell stock. So even with all those concerns we talked about, they believe the massive AI growth is enough to make the stock look a bit undervalued right now.
And that brings us right back to the ultimate question. Dell is making a huge bet here. They're betting that as this AI wave gets bigger and bigger, their profitability is going to rise with the tide. The entire market is watching very closely to see if that bet pays off. So, will this AI boom generate lasting, healthy profits for Dell, or just massive, low-margin revenue? I guess only time will tell.